Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. Today, we're diving into Agnc. Is it still a good buy in 2023? Morris Money is preparing for its next destination, 1,000 subscribers. Make sure you're here for the ride by subscribing to Morris Money. Last year was downright awful for the mortgage space. To help combat rising inflation, the Federal Reserve aggressively hiked interest rates beginning in March and going throughout the year, which crushed mortgage real estate investment trusts, better known as REITs. As a result, many of the mortgage REITs saw their stock prices fall and their dividend yields reach eye-popping dividend levels. Agnc is one of the biggest mortgage REITs in the country and is now trading with a yield in the mid-teens. Does that make the stock a buy or one to avoid? Mortgage REITs are different than the typical REIT. Most REITs invest in properties such as office buildings or shopping malls and then subdivide the space and charge rent. Mortgage REITs don't invest in properties, they invest in property debt, in other words, mortgages. Instead of receiving rent, they receive interest. Agency Investment is an agency mortgage REIT, which means it invests primarily in mortgage-backed securities, which are guaranteed by the U.S. government. If you recently refinanced your mortgage with a loan backed by Fannie Mae or Freddie Mac, your loan was probably pooled into a mortgage-backed security that might have been bought by an investor like Agency Investment. Even if you were to skip your mortgage payment, the government will ensure that Agency Investment gets its money. This means that Agency Investment takes on almost no credit risk from the mortgage-backed securities in its portfolio. It's also important to understand, though, that no credit risk doesn't mean no risk. It means that Agenc takes a different kind of risk, specifically interest rate risk. Think back to your recent mortgage loan. If you refinanced a year ago, you probably have a 3.5% mortgage rate. How does Agenc turn a bunch of mortgage-backed securities paying 3.5% into a mid-teens dividend yield? Simple, leveraged, or borrowed money, and a lot of it. At the end of the third quarter of 2022, Agnc had a leverage ratio of 8.7 times, which means that the vast majority of its mortgage portfolio has been bought with borrowed money. It's very similar to when you buy a stock on margin. Leverage magnifies potential gains, but it also magnifies potential losses. This was an issue early in the pandemic when the mortgage-backed securities market froze and Agenc's bankers asked for additional margin. Agenc ended up cutting its dividend to preserve cash. The other issue for mortgage REITs is that their assets have a long maturity and their borrowings are very short term. Think back to your 3.5% mortgage. If Agenc can borrow money at 1%, everything is great. But what happens if the cost to borrow is 4%? Agenc uses interest rate derivatives to help mitigate this risk, but it can't be completely hedged. So interest rate risk is a serious risk for mortgage REITs in general, and investors need to keep that in mind. No credit risk does not equate to no risk. Ultimately, the success of Agenc will depend on what the Fed does. Over the past year, the difference between the yield on U.S. Treasuries and the comparable mortgage-backed security has risen past levels seen during the depths of the 2008 financial crisis. This has been driven primarily by fears of quantitative tightening and the possibility that the Federal Reserve might sell off some of its multi-trillion-dollar mortgage-backed security portfolio. This difference, also referred to as mortgage-backed security spreads, seems to have peaked in the fall and is now returning to normal. This represents potential additional returns on Agenc and should translate into higher book values per share. Now, the ultimate question: with a 13.9% dividend yield, is Agenc Investment a potential buy in 2023? The risk is that mortgage-backed security spreads begin to widen and that the Fed continues to hike interest rates. While the Federal Reserve sees the end of 2023 federal funds rate between 5.1% and 5.4%, the markets consider that to be a long shot. Generally speaking, mortgage REITs trade right around book value per share, and Agenc is trading above its end of September book value per share of $10.04 per share. If you can get it below book value, it should be a reasonable valuation, given that mortgage-backed security spreads are tightening. And there you have it. That's the ultimate factor with Agenc and mortgage REITs in general. What you want to find is companies trading below its book value per share. And at $10.04 per share, Agenc has to shed about $2 to get it below book value. But what I challenge you to do is try to find mortgage REITs trading under their book value. This is actually something I might look into and possibly have a bit of an arbitrage investment, finding mortgage REITs that are under their book value and holding them until they get above that book value. But let me know what you think about Agnc below, because I've had it in my portfolio for a couple years now, and if it were to sell off again, I might be buying in and buying some more Agnc stock. Let me know your thoughts about Agnc down below for 2023. Please don't take this video as financial advice, and thank you for watching Morris Money.